Between 2025 and 2030, the Indian economy enters a critical testing ground. As it aims for the position of the world's third-largest economy, its trajectory depends on a single, vital variable: the future of domestic price stability. The official institutional forecast from the International Monetary Fund and the Reserve Bank of India projects a remarkably stable path. They expect headline inflation to remain flat at 4.0% through the end of the decade. However, a different picture emerges from an ARIMA model, an autoregressive integrated moving average. This is a statistical algorithm that forecasts future data points strictly by analyzing past mathematical patterns. Trained on 65 years of India's historical data, the algorithm projects a steady upward drift, settling near 7.2%. This creates a 300 basis point gap between the policy target and the mathematical projection. The ARIMA model operates on the principle of stationarity. It assumes that the underlying mechanics of the economy are constant and that the future will inevitably reflect the long-term patterns of the past. The IMF forecast rejects that assumption. It rests on the premise that the 2016 adoption of the flexible inflation targeting framework has changed the way the Indian economy responds to price shocks. This gap represents a deep disagreement over whether a new policy framework can successfully override decades of statistical inertia. The choice of model matters. If the algorithm's projection is correct, the economy would return to an inflation level that has historically triggered significant instability. These two lines represent two competing economic worldviews: the structuralists, who prioritize historical supply constraints, and the monetarists, who believe central bank credibility is the primary anchor for prices. To find out which projection holds the truth, we must dissect the structural anatomy of Indian inflation. Understanding why an algorithm insists on 7.2% requires measuring the unrelenting weight of 65 years of macroeconomic history. We begin by looking backward, examining the complete empirical record of the Indian Republic to see exactly what the algorithm learned. This chart tracks India's Consumer Price Index. Since 1960, it reveals a sequence of sharp oscillations. Inflation reached a peak of 29% in 1974, before swinging into a deflationary trough of negative 7.6% just 2 years later. These extreme swings pull the algorithm's long-term average towards 7.3%. The volatility is driven by three interconnected spheres: monetary policy, fiscal spending, and supply-side shocks. Historically, the most consistent driver of inflation was the relationship between government deficits and the central bank's response. Economists call the period from 1978 to 2003 the era of fiscal dominance. During this time, the central bank was often required to directly monetize the government's fiscal deficits. This meant the central bank absorbed government debt by expanding M3, the broad money supply, which includes all physical currency and bank deposits. This injected liquidity into the system without an equivalent increase in real economic output. This expansion of the monetary base consistently elevated the baseline cost of living across the entire economy for decades. When the ARIMA algorithm projects a 7.2% future, it is factoring in this long history of the central bank accommodating government deficits rather than prioritizing price stability. While monetary expansion sets the long-term trend, the sudden short-term spikes in Indian inflation are driven by a different mechanism. The Indian CPI basket is unique. Food and beverages account for roughly 46% of its total weighting. In most Western economies, that figure is significantly lower. This creates a direct link between national price levels and the domestic agricultural cycle, which is itself tied to unpredictable monsoon patterns. When weather disruptions are combined with fragmented supply chains and a lack of cold storage infrastructure, the result is an immediate supply bottleneck. These bottlenecks create a right-skewed distribution. In this statistical pattern, massive price jumps in a few specific items, like onions or fuel, pull the overall headline average upward, even if most other prices are stable. This chart compares the erratic blue line of headline inflation to the dashed orange line, a smoothed proxy for core inflation that removes those volatile food and energy shocks. This data isolates the episodic supply shocks. The blue bars represent moments where the headline rate deviated sharply from the underlying trend due to external factors. In many economies, these shocks are temporary, but in India, they often trigger a contagion effect. Because food is such a large part of the household budget, these temporary spikes quickly influence inflation expectations, leading to demands for higher wages and raising the long-term core trend. The ARIMA model predicts high inflation because it assumes these structural vulnerabilities remain fixed components of the Indian economy. The IMF's optimism is based on a different reading of the data. Conventional theory suggests developing nations can tolerate higher inflation to support growth, but India's history suggests a limit. This scatter plot of inflation versus unemployment shows no clear inverse relationship. The data is dispersed. Research by former central bank governor Dr. Rangarajan identified a threshold hypothesis, a limit between 5.5 and 6.0%. When inflation stays below 6%, the economy remains relatively stable. But once it crosses that line, the data suggests that growth is actually suppressed as price signals become distorted. Above this threshold, uncertainty rises, savings are penalized, and long-term private investment drops. Inflation above 6% acts as a drag on the economy. This evidence led to a major institutional shift, the 2016 adoption of the Flexible Inflation Targeting Framework. This framework legally mandated the central bank to prioritize a 4% target, ending the era where monetary policy was secondary to government deficit financing. This chart tracks rolling volatility, the degree to which the inflation rate fluctuates over time. Following the 2016 reform, volatility collapsed. The rate settled into a much narrower, more predictable band. This suggests the central bank successfully anchored the public's expectations, preventing short-term supply shocks from consistently mutating into long-term price spirals. The IMF projects a flat 4% future because it views the 2016 policy transition as a clean break from the past. For institutional forecasters, the central bank's new mandate has changed the economy's operational baseline, making the algorithm's long-term history a poor predictor of the future. We are left with the original paradox, historical inertia versus policy credibility. The ARIMA algorithm is structurally blind to the new credibility of the central bank. It only knows that for 60 years, the gravity of the Indian economy has pulled inflation back towards 7%. But the IMF's projection assumes that policy credibility can fully insulate the economy from physical constraints. Structuralist critics argue that monetary policy is primarily a blunt instrument. It can manage demand, but it cannot resolve physical supply shortages. If a harvest fails, changing the repo rate, the rate at which the central bank lends to commercial banks, will not create more food. Interest rates cannot build roads or cold storage units. This scatter plot shows the weak relationship between inflation and agricultural growth, illustrating that prices are often dictated by factors far outside the central bank's control. As long as weather patterns and global energy prices dictate the cost of basic needs, the central bank is forced to react to shocks it did not create. To maintain the 4% target, monetary policy requires support from the government in the form of agricultural logistics reform, land reform, and energy independence. The next 5 years will determine whether institutional credibility is enough to rewrite a nation's economic character. If India sustains its 4% target, it will prove that policy can successfully override history. But if the physical supply-side issues are not addressed, the algorithm's mathematical forecast may yet be the accurate one.